Good afternoon to all of our viewers from across the United States. It is November 4th of 2021. Crazy to think we only have really, if we think about it, 6 to 7 weeks left in the year. And it's been a strange year. It's been a chaotic year. But as we close out the end of 2021, we do think the portfolios are well positioned to take advantage of a strong seasonality on the side of markets, on the side of risk. And number two, as the markets continue to make that generational shift away from high price, traditional growth areas of the market, such as technology, and toward those more old economy areas of the market that are more value oriented, have cheaper prices, cheaper valuations, that are really, at the end of the day, going to experience the majority of the benefit of the reacceleration of economic growth in Q4 and Q1 of 2021 and 22. That's where our focus is. Does that mean we're going to miss some stocks along the way, as there's there's obviously thousands of stocks out there? Absolutely. But we got to stay focused to our game plan. We got to stay focused on the broad themes that we think will be tailwinds for not just the next couple of months, but for the next few years. And that's where our focus is going to continue to be. And so this week's update is titled, "Want to Lose Money? Then Listen to the Media." And there's a reason why we called the presentation that this week. And that is because as we entered into the week, everyone started to get scared about the Federal Reserve and the boogeyman of tapering. And lo and behold, we had a pretty good week. So, we wanted to take this chance to really reassert our message, which was, after a decade of market leadership from technology, we do expect a rise in long-term interest rates. Yes, bond yields have backed up the last couple of days, but the longer-term shift in interest rates to ignite a sustainable shift from growth to value. So the three key takeaways for this week's presentation: the economy does appear to be reaccelerating after that summer lull caused by the COVID Delta variant. Number two, we are in the early innings, not the middle innings, late innings. We are in the early innings of a shift away from speculative growth and toward low price value stocks. And of course, number three, we continue to see that energy and financials are well positioned to lead that shift. Now, we showed this slide last week, and we're probably going to show it many times over and over and over again. Why? The media is not your friend. When we look across our advisor and client base, the number one variable between what the returns that we published, what we say are those actual returns, had clients stuck with us through thick and thin, versus realized outcomes of clients that are impacted by the media, sell and then come back in, then sell and come back in. The number one culprit to those deteriorating long-term returns, to both whether you're a client of ours or an outside investor, is the media. The media does such a hit job on our long-term returns. We spend so much time coaching clients and advisors on ignoring the media. And this is why. There's been no shortage of fear factors to get out of the market as pushed by the media. But guess what? The media is not held accountable. You can't fire the media if they're wrong. I heard a great phrase today. Zero Hedge blog should be called Zero Edge. And we have to do our job as coaches, as investors, for our clients, to ignore this garbage. What kills stocks are recessions, and recessions are caused by either a contraction in the inventory cycle, or a contraction in credit. Those are really sort of the two prime culprits to what hurt bull markets. So, again, yes, the Federal Reserve was tapering this week. That scared a lot of people. Oh my God, they're tapering. They're not going to buy bonds and print money to the same pace that they were a month ago. I got news for everyone. At 4 to 5% GDP growth, 0.5% interest rates, with a Federal Reserve that's still buying bonds, that's incredibly easy money. That's incredibly easy Federal Reserve policy. In other words, Federal Reserve policy remains insanely accommodative, and that tends to be good for stocks. So please ignore the media. The Fed tapering, we can add another check mark to this chart over here as another hit job by the media to scare us out of valuable merchandise. Please don't listen to the media when it comes to investing. It's the number one way to lose money, and it's the number one way to tamp down long-term returns. What is reality? The reality is that the economy is starting to reaccelerate. ISM services, now we pay attention to ISM manufacturing, it is important, but services are 70% of GDP. Look at what's happening with services here. This doesn't happen ahead of or during a recession. In addition to that, in conjunction with that, we see jobless claims that are continuing to fall. We're back down to 269,000 weekly jobless claims. That was the number we were experiencing before the pandemic. So to those people that saying the world is about to end, we don't see it in the data, right? And if the world's going to end, do we really care what Apple stock is going to do? That's one thing I always say to a lot of clients in one-on-one meetings is that if you really think the world's going to end, if you think the US is going to dissolve as a country, who cares what your stocks are doing, right? Like, we got bigger problems on our plate. So the next question we have to ask is stocks or bonds or cash or real estate. And so the way we always look at that is a comparative analysis. Which asset class looks better? Because yes, we can always talk about whether stocks are expensive, but remember that money has to go somewhere once we sell the stock. So if we sell a stock, we then own cash. Inflation's at 4%. So we're going to lose 4% on that cash. So we got to put it somewhere else. Well, bonds at 0 to 1% interest rates, that's really not attractive, especially with 4% inflation. Real estate's at an all-time high. That doesn't look very attractive when we consider what the rental yield is relative to the average real estate price on a single family home. So real estate is more expensive than stocks. Bonds are more expensive than stocks. Cash is trash. Guess what? Stocks look pretty good, and the numbers play it out. When we look at the earnings yield of the average stock on the S&P 500 minus the 10-year treasury yield, we're in that positive one standard deviation of observations throughout history. In other words, when this line is higher, stocks are more attractive relative to bonds. When we're below this dotted line in the middle, bonds are more attractive to stocks on a valuation basis. And the same thing holds true with corporate bonds relative to stocks. Again, one standard deviation above that neutral zone. In other words, stocks are more attractive than corporate bonds. Now, we've always talked about this shift from growth to value. Now, one of the ways that we can illustrate that is through words, or we can illustrate that through illustrations, through pictures. And this is one of my favorite charts right now because it shows the annualized trailing 10-year return of growth relative to value. Now, typically speaking, when we get north of 6%, we're kind of in that bubble zone where historically speaking, we start to see a mean reversion trade back towards value. Back in 2009, it was the other way around. Value had a decade-long run relative to growth, initially really caused by that tech bubble, right? Remember, we've talked about the tech bubble valuations back in 2000 and the fact that valuations are more expensive today. Well, again, just one more feather in the cap here to that whole argument. When we look at growth relative to value, hasn't been this extreme since 2000. So what's a good way to stay in the stock market, make some money, hold some merchandise that's pretty attractively valued, well underneath the S&P 500 valuation? Let's look at value stocks that are exposed to the economic reacceleration, the commodity cycle, which we think is in the early innings, and the manufacturing and infrastructure renaissance across the Western world. That's where we want to stay focused in terms of our investing. So where's the quantitative leadership in the stock market right now? Well, we can see here, these are sector ETF flows. We had a very strong inflow movement into cyclicals, financials, energy, materials, industrials, discretionary, when the initial vaccines got announced in November of last year. But notice what happened. They got a little bit overbought. Then we had the Delta variant, and we can see that really tailed off. And that was part of our underperformance in the middle part of the year. And now we're seeing that reaccelerate. But notice the separation between the cyclical leadership. Energy and financials have really started to separate themselves from materials, industrials, and discretionary. Now, the one area we think that we could see a catch up is in discretionary. We're seeing some really good, healthy trade action in the discretionary stocks. We're seeing relative performance break out on a lot of individual discretionary stocks. Another thing to stay focused on is discretionary is 50% of discretionary is Tesla and Amazon. We kind of strip those out. The equal weight discretionary index actually looks really, really attractive. Not that it wouldn't with Tesla, obviously pulling a lot of weight, but Amazon has been a drag to offset that a little bit. Now, one area we think that I think people are getting a little bit over their skis on is the concern around inflation. Do we think inflation is going to be sticky around 3 or 4%? Yeah, we do. Do we think it's going to be 5, 6, 7, 8%? No, we don't. And so when we see TIPS ETF flows getting really extreme like this, it kind of tells us maybe the market is getting a little bit hypersensitive to inflation. From a positioning standpoint, right now, energy, natural gas, and the Japanese yen seem to be pretty favorably positioned when we look at when you look at where investors are positioned and where we think flows go in the future. The way you want to look at this is when investors get super bearish or net short in the CFTC table, you kind of want to take the other side of the trade, historically speaking. So right now, record shorts in the yen. Believe it or not, even with the strong move in oil, investors are still net short, and that holds true with natural gas as well. So the fact that the fundamentals continue to accelerate in energy and natural gas, and quite frankly for export markets such as Japan, I think really speaks volumes as to what's taking place underneath the surface. So right now we're going to stay true to our energy and natural gas overweight as it relates to the portfolio. The yen doesn't really impact us that much, to be perfectly honest. Where we see this, the other side is the dollar, copper, S&P 500, a little bit of bullish positioning there. So again, we want to be careful with S&P 500 heavily impacted by that 40% weight in tech and communications, specifically FANG, right? So Facebook, Apple, Netflix, Google, Tesla, Microsoft, etc. These are those big stocks that we think are actually a little bit overbought at these levels, where the S&P 500 can come down like it did in September and October while our strategy goes up. Of course, we can't guarantee that, but we think something like that could be playing out. And then continued healthy quant signals. The cumulative advanced decline line, in other words, advancing stocks relative to declining stocks, continues to break out upward and to the right. We want to see that. More stocks participating in the party. We don't want to see fewer stocks. We want to see breadth expand, increase, bring more and more stocks as higher economic growth distributes the benefits to a wider array of companies. And we can see that in earnings estimates across Wall Street. So yes, 2021, interesting, we have actually seen earnings revisions increase throughout the year. Typically, your most bullish earnings forecasts occur at the start of the year and then are revised downward throughout the year. We've been getting revised upward throughout the year, and 2022 is expecting growth on top of that. So again, from a quant perspective, from a style perspective, from a breadth perspective, from an earnings perspective, things look pretty good right now. It's hard to get too negative out there. Now, as you know, we're very overweight energy relative to the S&P 500. Why is that? Because it's cheap. It's really, really cheap. In fact, Tesla is now worth more than the entire S&P 500 energy sector. I want people to think about that for a second. We got companies like Chevron and Occidental and Schlumberger and Devon Energy and Marathon that are posting 25% free cash flow yields, while Tesla's maybe 1% free cash flow yield. Tesla is now bigger than that entire group. So which is cheaper? You tell me, which looks more attractive? Again, we love Tesla. That being said, a great company can have an overpriced stock. So we prefer actually the traditional energy space. And then of course, credit markets remain intact. If we saw anything that was beginning to crack, we'd see it here in credit first, traditionally speaking. So again, nothing really there that keeps us awake at night. So overall, please, ladies and gentlemen, ignore those fear mongers out there. You own companies. Those companies are making more money. And when they're making more and more money, at some point it gets reflected in the stock price. So to wrap things up, we are in the early stages of an economic expansion. We're talking second, third inning. We're going to see that acceleration most likely here over the next 2 months. Number two, economically sensitive stocks are expected to outperform. The portfolio is positioned as such. And of course, that energy and financial stocks remain those durable leaders. Thank you again for tuning in and for all of your business and for all of your loyalty as we have gone through a lot of volatility this year, but we are certainly eternally grateful. And if you have any questions, please feel free to contact your advisor, or you can contact us here at our offices. Thank you again and have an absolutely fantastic weekend.